Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So in this video, we're going to do another velocity banking review with real life numbers. And how do I know if they're real life numbers or not? It's because these are my numbers. And so I have a home equity line of credit. You can see here that the previous balance or the previous statement balance is about $7,000. Again, I dump all income sources, whether it's rental income, whether it's YouTube income, all types of income. I dump it into my line of credit and then the expenses come out. Now, of course, you do get charged for using that line of credit. And my home equity line of credit here is 10%. But just as long as you have the cash flow, I mean, who cares about whether it's 10% or not? The line of credit gives you so much flexibility to pay your debts and bills that I don't care if it's 10%, right? What matters is that cash flow number, okay? So in practice, what is velocity banking? You're basically paying off all your debts, no savings, with the help of a line of credit, and the actual implementation of the strategy is all of your pay goes into that line of credit, and then your expenses come out. You get charged some interest based on your cash flow and the average daily balance. And whatever is your new balance here, your leftover balance, and that's the end of the monthly statement. Boom, right? You see how easy that is? And in order for you to do velocity banking in your own personal situation, you need a line of credit, right? And there's different types of lines of credit. There's a home equity line of credit, personal, even credit cards might work if you want to use a credit card. When I first did it, I used a credit card, right? I was like, whoa, I can pay a part of my mortgage with a Discover card of Plastique. And then, I got some, I guess, cash back and they expanded my credit limit because I'm using it, paying it off, and it's like, whoa, I got some benefits here, right? And so, again, you need a line of credit, and you should get as much credit as possible before you ever need it, because banks only lend people who don't need money. And I don't know if you've seen any of my other videos, but I have over $279,000. I think it's over $279,000 in lines of credit. And when you hang out with people who are into the education that we've learned, then getting $279,000 doesn't seem like a big deal. In fact, I met a gentleman who does real estate in the Miami area. Like I've known him for quite a while, and he's like, I have over $1 million in lines of credit. And I was like, dang, I only got 279,000, right? So when you hang out with people who are like that, then your standards become raised. And that's why it's important to kind of get out of your bubble and stop thinking, oh, I can't get a line of credit. Of course you can if you know what banks are looking for. And banks don't like to work with people who don't have money, and they don't like to lend money to people who need it, right? Most important thing about getting a line of credit. And this is a $50,000 HELOC. Again, all what is the velocity banking strategy in practice? It's all your money goes into line of credit, expenses come out, and then you rinse and repeat over and over again. And we'll show you here how you can apply that strategy possibly in your own life, right? So let's just go ahead and do this. So let's assume, and again, your debt is always going to be proportional to your income, right? Unless for some reason you live in Hawaii and you have three households living in the same house, and the average median Hawaiian salary is like, I think, 150,000, but the average home is like 1 million and something. So I think and I think they do this in Los Angeles too. Like, I don't know how people actually buy homes in Los Angeles, but I think the only way you can actually buy a home there is that you live in a multi-generational household, right? So, okay. So what we're going to do is we're going to write our income, we're going to write our expenses, we're going to write how much is left over in savings, and then we're going to do an expense breakdown of every single debt that we have, because what is velocity banking? All it is a debt payoff strategy, right? Debt payoff strategy. And the more debt that you pay off, the more cash flow increases, which helps you pay off other debt with the help of a line of credit. So we have two credit cards here, two auto loans, and a mortgage, right? And I don't know if you've ever been to like any of these affordability calculator websites, But if you put in your income and your monthly debts and maybe like a down payment, the affordability calculator tells you how much home you can buy. So if you take a look here, you add up all these debts. This is about like $1,300. And according to this, let's say you make $100,000 and $6,000 a month net is actually $100,000 a year. You can only buy a house that's about $200,000, a $200,000 house, right? And there are so many people out there who are buying like who probably don't even make good money, or maybe they do, but they have all this other debt too, that they're trying to buy a 300 or 400 or $500,000 house. And I feel like I can't even afford like a 300 or 400, $500,000 house. You know what I'm saying? But maybe that's because the reason, I'm a little bit more wealthy than I used to be is because I understood that the easiest way to create wealth is to buy a home at a discount, right? So, but this is, I think, really interesting about how much home you should afford. So, according to this, if I have even a six-figure salary, but I have this debt, I should only get about a $200,000 home. Okay, so let's go back here. So now we have a budget. Now we have to have a line of credit as our main operating account. So let's just assume that we have a $50,000 home equity line of credit. All it is kind of like a credit card based on the value of your home. But the beauty of the home equity line of credit is that it's so flexible that you can use it to pay anything. So for example, let's say like I borrow money from this home equity line of credit and $50 is due. I could just borrow that $50 from the home equity line of credit and pay it back. And if you want to see this, go to the community tab of this channel. And again, this is just 11 hours ago. And you know what's funny? You know what's really funny about this? Like, I know that, when I show numbers like this isn't real. People think this isn't realistic. And, it's kind of out of their league. And how do I know that? It's because if I take a look at the number of likes here, it's only 2 likes, right? And so it's like, whoa, like I don't, not in my, and I'm not insulting anybody, right? I'm just saying that sometimes when you say, hey, I could pay $10,000 in 6 months, that's more attractive to people than saying I can pay $167,000 of debt in 3 years, right? And how do I know this? Is because when I take a look at one of my other posts, okay? So for example, I got a new checking account for $400. Look at this, 11 likes, right? But when I say, oh my goodness, I paid off all of this debt and put 18 grand into a line of credit, to only 2 likes, right? So sometimes, we got to start small, step by step. And I know that when I show my numbers, people won't be able to really relate with it. But let's just kind of use numbers that are kind of semi-realistic. Although, once you get so successful, there's honestly going to be a point where you just can't relate to the average person anymore, right? It's like you're in the NFL and everyone else is like in Pee Wee Little League. You're gonna crush them, and you won't remember what it's like to be in Pee Wee. Is it called Pee Wee football? Little League? I don't even know what they call it, but you get what I'm talking about, right? All right, so let's assume that we have a $50,000 home equity line of credit, okay? And we assume it's same income, but here's the most important part. Instead of saving $1,000 like Mr. Dave Ramsey tells us to, we're not going to save any money at all. And we're going to have something called cash flow, which is a little bit different from our savings. In the beginning, it's going to look the very same because it's just income minus expenses, but we're not going to save any money, okay? Because when we do velocity banking, what is actually velocity banking? It's having our line of credit as our main operating account when we pay off debt, right? So when we're the average American, what do we use to pay off debt? What do we use as our main operating account? It's our checking account. When we're doing velocity banking, what do we use as our main operating account? It's our line of credit. So this $50,000 line of credit is going to be our main operating account, right? So now, in order to start doing velocity banking, because we're going to use this as our main operating account, we're going to move some debt into it, right? So why don't we just start simple and move this $13,000 of credit card debt into that home equity line of credit, 13,000. Okay? Now, this 13,000, just by simply doing a debt transfer, guess what happens to these payments? 0, 0, right? So we've basically increased our cash flow about 1,400. And let's do this. Let's go ahead and pay this off. okay, and focus all our debt into this home equity line of credit. So let's go ahead and figure out the next month's balance, because again, we're putting this entire $6,000 into that home equity line of credit, just like I showed here. We put our entire pay, it doesn't matter where it comes from, whether it's from YouTube income, whether it's from your rental property, whether it's from your job, whether it's from your parents. Again, all that money is going to go into your home equity line of credit. Okay, your home equity line of credit. So we're going to do all that, put that $6,000 in, and those two things, it satisfies the minimum monthly payment and it minimizes the interest, right? That's the two big benefits of putting your entire $6,000 in. And then after every single month, the balance is going to go down by our cash flow. All right, so now let's go ahead and do this. So G2 plus H2. So to get the next month's balance, you get the previous month's balance, previous month's interest, minus this cash flow, which is 1443.53, right? And then what we're going to do is we're going to take the average of these two numbers, right? Or use the average function, estimate it as the average daily balance, multiplied by the interest rate, which is 10%, and then divide by 12. Now, right now, my home equity line of credit is a 10% interest rate, but I think I'm going to get a new one soon where the interest rate will be 8.5. And usually, if you get a home equity line of credit with the credit union, they will give you lower rates than, let's say, a bank will, right? And I have a home equity line of credit with a regional bank. All right, so now we have these three formulas, and all we got to do is just copy and paste. And so now let's go ahead and highlight this. It takes us about 10 months to pay off $13,000 of debt. All right, so 10 months, 13K of debt. That was easy. And now we got to figure out, because what we have is two auto loans and a mortgage. What are we going to do here? Okay, what are we going to do here? And so what I like to do when it comes to lower interest rate loans, I like to do something called chunking, which is just moving parts of the what's it called? Loan into the line of credit and just paying it off in pieces. That's one way. Also, another thing that we have to consider is, what do we pay off first? Do we pay off our mortgage first? Should I pay off this auto loan? Should I pay off this auto loan? Which one should I prioritize? And the way that I like to do is using a formula called the cash flow index, right? And all the cash flow index is just the statement balance divided by the minimum monthly payment. I'll show you how you calculate that. So it equals 16659.05 divided by this payment right here, 415.17, okay? And then this one is, actually, you know what? What's the balance right now? It's actually 10 months, so let's go here and recalculate this. Okay, so I did this here, and let me go in here. So 16659.05. 16659.05 plus 10 months, because that's how long it took us, so that'll be 26. So that'll be 13K. Okay. So now the current balance after 10 months is about 13,000. And you might say, how did I do that so quickly? It's because, again, I just practice this over and over again. Once you do this so many times, you kind of become new in the matrix. And I could figure out it really easily if velocity banking is or is not gonna help you. Like 99% of the time, the one thing that has made me say I don't think this can help you is when people overpay for housing. There have been people, right? I've seen email me their spreadsheets and they're like, I'm paying 75% for housing. It's like, good luck to see it. I don't think this is going to help you, right? Well, but that's just me. All right, so now let's go ahead and do this. So let's go ahead and figure out the cash flow index here. And we'll just briefly go over what this means. And the reason I like the cash flow index, right, is because once upon a time, somebody sent me their spreadsheet and it had like 15 debts. And I was like, I'm so confused about which one to pay off. And then that's when I really fell in love with the cash flow index system, because it basically showed me the order of debts to pay off with a simple formula, right? And so basically, if you just do this, and let's go back here, 24,000. 5 years at, what did I put? 4%? 4%. 4%. Okay. So, and then after 10 months, be 20 grand. Okay. So that's the current balance right now. And let's calculate that cash flow index. 20325.25 divided by 442.2. Okay. And then let's do the mortgage. So $200,000 at 6%. 200,000. 30 years at 6%. Okay. And then let's take a look after 10 months. How much how much is the balance? So $197,000. Look at all this interest we're paying versus the principal, right? And I think if you ever just do basic calculations, you'll see that it takes us you about like 17 years for this number to equal this number, I think. I mean, let's just quickly check, right? What year is it exactly the same about? Year 19. You see this? 71 to 72. This is like around the time where the payment where principal and interest are almost exactly the same. It's crazy. It takes 19 years. People don't know that. All right, so now what is my cash flow index at this time? 197,000, so 197,963, 63.59 divided by 1199.1, and let's put an equal sign. Let's put an equal sign. Okay, so ignore the dollar sign. But basically, if you want to know what the cash flow index system is, think of it as a ranking system for which debts you pay off, right? And the lower the number, again, this system was invented by me. It was invented by Garrett Gunderson. The more inefficient your loan is, so think about this: would you pay $13,000 to get $400 back, or $20,000 to get $440 back, right? Which one gives you more bang for your buck? It's obviously this one, right? You get 13 grand for 415 versus 20 grand versus 442, and nobody, would in their right mind would pay $197,000 to get $1,200 back, right? And this is why you have to pay them in a certain order, get that cash flow, and then use that to pay off your debts. And this is why I say pay off your, like, I've never seen a situation where you pay your mortgage first and then you pay off your other debts. That absolutely makes no sense, right? We want to get our bang for our buck when we're paying off this debt. And so right here you can see that this is the lowest number. Again, it's like a ranking system. So what I'm going to do is put this 13 grand, okay, this 13 grand of debt into that line of credit right here, into this line of credit. So let's put this 13 grand here, okay? And when we put this 13 grand into that line of credit, guess what happens? This auto loan payment is now zero, and now we have $1,800 of cash flow. 1,800, right? So what we do is now in the next months, right, we subtract 1,858.7, okay? And then we just see how long it takes us to pay off this auto loan. Bam, 17 months. Okay, so 17 months. And how much is that? So about 13. So actually, what did I start out with? I don't remember. I'll just say 22 because I can't remember what. I'm assuming I started at 22, but then I think I was like 16K. So it was like kind of partially paid, right? So 16 plus 13 is 29K. Okay, not bad. All right, so now what is our cash flow index at 17? So let's just take a look here. 2454, and then 17 month 17 is 16,000. All right, so now, so what's our cash flow index right here? 16313.3. Again, It's still a very low number, so what we can do is just move this into the home equity line of credit. So 16313.3, and then just move it to here, right? Plus 16313.3, and then bam, so second car, just the loan has been transferred to a line of credit, and then we transfer that and this becomes zero, and now we have $2,300 in cash flow, right? So look how we started here. So we're at $1,000 of savings a month, which is pretty good, right? Because there's studies say that the average American can even afford $1,000 emergency, but then now we're doing pretty good, and now we're doing better, right? 2,300.9. So 2,300.9 is our new cash flow. So let's go ahead and subtract that to a 2,300.9, okay? And let's see how long it takes for us to pay off this line of credit. So about 25 months, okay? So 25 months, and so 29,000 plus 24, which is 53,000. Bam, all good, right? So now what we have to do is figure out what the mortgage is. And the mortgage is always usually, I call it a little bit of special case, because it is the loan that takes up the least amount of cash flow. And it's very important that we understand this, because most people, sometimes you hear on the internet, oh, always replace your mortgage with a line of credit. And many times it actually doesn't make sense unless you're getting like a special introductory rate and you have enough cash flow to kind of offset it, um, for that introductory rate, and makes sense to replace it. Hopefully that makes sense. If it doesn't, that's because I'm really sleepy and it's almost like 12 a.m. and I can't stay awake. But let's go ahead and see if we can finish this. All right. So now at 25 months, what is so we'll say 6%, 25 months. What is the balance of the line of credit? It's 194. Okay. Okay. So I want to show, this is what I want to emphasize, right? So how do I explain this? If you have the mortgage, I would always suggest you do something called chunking, right? Basically taking an equivalent, that's kind of something equivalent around like a low amount, whether it's like $10,000 or just maybe around your income, moving it to a line of credit and then just dumping all your income there to pay it off. It's much easier than sending extra payments to loans directly, because of a phenomenon called segregation of income, right? And the fact that once you send all your money to that loan, you're not going to get it back. And for most people, because they know that, that's why they feel uncomfortable having zero savings, which is what velocity banking is if you deconstruct it, right? It's zero savings with the help of a line of credit. So let's just go ahead and do this. So let's say we moved 194 and we made to move $10,000, say 184K, so $10,000 into that line of credit. Okay, so I'm going to move $10,000 here. Again, our cash flow is the same because we haven't paid off that line of credit yet. How long does it take to pay off that $10,000 approximately? 1, 2, 3, about 4 months, right? Yet if we followed the bank's schedule for that mortgage, how long would it take to go from 194 to 184, right? 194 to 184 would take about 1 year, 2 year, 3 year, 3.5 years, right? So basically, we basically kind of shrunk, or I don't know if shrunk is the right word, decreased the payoff time simply just by transferring a piece in a line of credit. And what matters is that at this point we have this maximum cash flow. Okay, the cash flow matters so much more than the interest rate. And this is why, even though my home equity line of credit is 10%, and let me go back here, this is a 10% line of credit. And lines of credit, the interest is pretty much calculated the same as a mortgage. The only difference is that average daily balance is how a home or line of credit is calculated, or that's how they calculate the interest, and the statement balance is how they calculate the interest for a mortgage. And the statement balance and the average daily balance are pretty much one and the same for a mortgage. If that doesn't make sense, I'm just saying that even though I have a 10% interest rate home equity line of credit, which most people would freak out about, I only paid $15 of interest for this month because I have enough cash flow to support using this line of credit. It's not so much the interest rate as much as having the cash flow, right? So let me go back here. And luckily, we have this velocity calculator where you could just input these numbers. And I got this from Renatus. And if you don't know Renatus, this is an online educational company. It's where I first learned velocity banking. Full disclosure, I'm actually an independent marketer. They call it independent contracting marketer for them. So I sell their educational products, and I get commission off of it. All right, so let me just go here, and all you gotta do is put in your numbers. So $6,000 of income, expenses. What is their expenses? It's everything except for the loan. So this would be 2,500 here. Okay, 2,500. And what is our current balance? So our current balance is this 194. 194. Oh, I'm getting so sleepy, but it's okay. I'm sleepy, but I'm well off. Ha ha ha. Okay, just doing a little bit of flexing there. All right, so now if you take a look at this, it says it's 5.5 year payoff time, right? Now, one thing I do want to emphasize, right, is I always say when you're dealing with a mortgage, just do the chunking method or doing in little pieces or chunks. So let's say even though this is a 10% interest line of credit, let's just do it in $10,000 chunks, right? Moving $10,000 to that home equity line of credit. And you can see here the years is 5.5 years and the interest is 34,000. So if I do 10,000, it's probably going to go up a little bit more, but let's see how much more, right? So about $1,000 more. Now, let's say that I decided I'm going to put the whole thing into home equity line of credit, right? Replace my mortgage with the first lien, whoopsie, home equity line of credit at 10%. And let's see what happens. So 5.5 years and 35 grand, 6.3 years and 68 grand, right? That's a no bueno. I mean, why would I pay double unless I didn't have to, right? And wait another year when I didn't have to, right? So there are certain instances where, yes, it will make sense to replace a mortgage with a line of credit, but that is very rare in my experience, right? You just do the chunking method, and you want to do that once you paid off all your other debts, okay? Usually. And if you don't have any other debts, then whether you pay your mortgage directly with extra payments or use this method is perfectly viable, but the likelihood that you're going to do it with extra payments is almost nil because almost nobody does that because it takes the average person about 52 years to pay off their mortgage. How does it happen? Refinancing, or they sell their home every 5 to 7 years, right? In fact, when I first moved into this neighborhood, after 1 year, people were like, there were two people on the street putting their home on the market. And if you know anything about real estate, if you put your home on the market after 1 year, uh, there, 10% of your almost 10% of the price is going to go to selling costs. So unless you made a significant amount, you ain't going to make any money, right? All right. Well, that's it for today. So let me go back here. So 6000. And again, whether it's 6,000 or 10,000, it's a very minimal amount just as long as you have the cash flow. And take a look at this. So let's say you did this with the 30% credit card, right? 30% credit card. How much more do you pay doing this chunking method, right? So about $6,000 more. But if you offset it with credit card points, right? Credit card points and use plastique and do churning, that would be crazy, right? So it's almost going to be the same if you're able to do that. And I think somebody was paid for a Tesla with a credit card. I don't think they did velocity banking, but they get all these rewards points for buying a credit card or Tesla with a credit card using a third party intermediary like Plastique. All right, well, that's enough rambling for today. So just before I go to sleep, I just want to show you how velocity banking looks like in real life. Again, paycheck into that line of credit, expenses out, interest, new balance over and over again. And isn't this what we showed in this velocity banking spreadsheet? Again, this $6,000 goes in, this $3,000 expenses comes out. And again, based on at what point of you are, then it's going to go down by your cash flow plus the interest. And as you can see here, the interest on this column is the same thing as this periodic finance charges based on the average daily balance. All right, well, that's it for today, everybody. Happy Friday, and I'm going to go to sleep now. Good night.